Litha Healthcare expects full-year headline earnings per share to be between 35 and 40% higher, while earnings per share are seen between 35 and 40% higher. Well, there we've got the clarity, but of course there's corporate action underfoot where Litha is concerned. I'm hoping that you're going to be able to explain the proposed transaction involving Paladin in Canada, Litha, etc., etc.
I'm not going to take you through the intricacies because it involves, buying shares in pharma plans.
It's too complicated for us, is what you're saying, and we don't have enough time.
No, I don't think there's time to go through all the detail, but effectively, Pharma Plan is Paladin's subsidiary in South Africa. What's going to happen is there'll be a share swap between Litha and Pharma Plan, whereby Litha buys 100% of Pharma Plan and issues shares at R2.75 for the stake in Pharma Plan to Paladin, and effectively Paladin then becomes a 49% shareholder in Litha. So it becomes a larger shareholder within Litha. So Paladin is the pharmaceutical company in Canada, as we've said, focusing on generics. The fit is very comfortable right now, and also it buys into the African story. You'll find a number of players coming through South African companies in order to play Africa, and this is just another one of those.
Now, in their bio division, they've got almost JV, I would say. They've got about 52%, the government's got about 40%, and that is in the provision and distribution of vaccines. Now,
Correct.
That must be very beneficial for the company to have that strong government relationship.
Extremely beneficial, and the reason is the margins on vaccines are far better than the margins on generics. And that really makes Litha a very attractive play for those who want to have exposure to that environment. Over the past few years, what we've seen is biotech stocks in the US pick up on new products coming through in the pipeline. So if Litha can start getting some of that benefit from Paladin, that will certainly help their margins going
Let's
forward.
put this question to you. Could Litha be the next Aspen?
Given its size where it is right now, yes. I've not really met management. I've only looked at the results on paper. So I'd need to get to understand what their strategy is and what their outlook is, and also how much they are willing to invest. Because the one thing that Aspen did was, when they took over SA Druggist, was invest significantly into, in terms of CapEx. With regards to plants up here in Gauteng, as well as plants in the Eastern Cape.
So in other words, it's a wait and see story. You're not completely convinced right now. They've got all the right ingredients.
Correct.
How do they translate it now into profits?
It comes down to effective delivery. I covered Aspen as an analyst 12 years ago, and what excited me most was to see management's commitment in terms of CapEx and their view over 5 to 7 years. So they weren't just trying to manage earnings. They were really taking a view on where the generics market would be.
Warrick, technically, could this be another Aspen? Are we heading in that direction?
I think it's certainly looking a bit healthier than Adcock at the moment, especially the last 3 months or so. Again, the accumulation phase coming into action here. My one issue with it is your volume. It's an extremely illiquid. These little bars over here are probably I think they're in the hundreds, or possibly, I think it's only in the hundreds. So you're looking at 415,000 traded yesterday, which isn't a hell of a lot of shares. So what ends up happening is that you get a fund manager coming in here and trading a couple of million trades shares, and you see the chart do this. So for me, technically, it's kind of a no-go area, no-fly zone at the moment. Purely based on the volumes.
It's difficult for you to read because, as you say, one move, one shareholder going in, buying a big tranche is going to radically change the direction of your graph.
That's right. So right now, I like the chart as it is, but I certainly wouldn't be taking a big bite in this one at the moment. The chart as it stands, as long as we're moving in this sort of level over here. And if you're going to hold it for medium to long term, I would put around R2, probably R2 as your support, and then just leave it alone for a year.
And from
or two.
a stock performance perspective, it has gone from 45 cents to around about R2.88. If R2 is your support, you saying?
Pretty much.
Well, from a stock performance, yes, it has done well, but you also have to look at the earnings that support it. and it's only, its PE ratio sitting around 13 times. You had Adcock's up earlier sitting 14, and then Aspen 17, just over 17 and a half. So not that richly priced when compared with its peers.
Difficult to read from a technical perspective, so we're going to have to go with your gut feeling on whether it's hot or not. Warrick?
Yeah, look, it's a bit of a problem, if you, at 3 Rand a share, 415,000 shares traded a day, it doesn't take a lot of money to start moving this chart.
So not hot?
Technically. But looking at the chart itself, I would say that right now I think it's looking better than Adcock, technically speaking.
Is it hot or not, sir?
I'd have to say no.
Not hot.
Because of the illiquidity.
I hope you're a bit quicker with your answer on this one. Hot or not?
You were handing out lukewarms earlier this week.
Don't tell me you want to use your one lukewarm. All right, Ashraf, you can use your one lukewarm on the show.
I'd go with not right now.
Not hot.
I would go with not, yeah.
All right.